Hey guys, this is Ashish with Investor Friendly CPA. We are the firm who focuses on mostly real estate investors for tax planning and tax preparation services. Today we have Dan here, which we're going to talk about a lot of real estate issues and taxes. I will let Dan introduce himself first. Hey Dan, what's going on?
Hi, how are you? Thank you for inviting me. I'm happy to be here, join you. My name is Dan Barrero, USA Land Ventures. I've been a real estate investor since 1989. I've been self-employed since 1985. My main objective is, to create generational wealth, but that isn't my primary objective. I just wanted to be rich. That's why I got into the real estate business. My main forte is long-term hold properties, but I use a lot of fix and flip to generate the cash to go buy those long-term hold properties.
That's awesome. I think most investors start with, for the quick cash flow, they will start with fix and flips, and then they start making money and they'll start making their own wealth through long-term real estate. But what I think what I'm going to focus on today, Dan, is talk about these new investors. They will go and fix and flip, make 100 grand and think, oh, I'm going to make a lot of money off of these. And they will go and pay 40–50% tax depending on which state they live. So if you want to really put all the money back in your pocket, all the money, really, if you really wanted to, or most of the money, then you really need to think about taxes. And that's what I like to talk about. And if you want to talk about anything else, please chime in. But my goal is to just talk about, hey, let's say what happens to a new investor when they fix and flip, and how should they be mitigating their taxes. That's what I'm going to focus on first. And then we can talk about long-term rentals, all the 1030 exchanges, short-term rentals that people are doing right now, and in commercial properties, investing in all these funds and GPs and LPs. Everything is real estate. It's just which class of assets you need to invest in. How does it affect you in taxes, depending on what your life is. Meaning, are you doing this full-time real estate, or this is just your investment on the side? So many tax implications depending on what you're doing. I can talk about this for 10 hours. Obviously, we're not going to cover everything. To help new investors so that they can at least start the conversation with their own tax professional or someone like you who really teaches them how to get started. Maybe we need to just focus on a few things here. Is that okay with you?
Yeah, absolutely. I love something that you brought up, how, some people think if they made 100 grand, let's say, on a fix and flip, that's theirs. In reality, it isn't. So I'd love to talk more about that, because the truth is that I don't think, especially new people that come into the business, or people that, in their first year, truly realize the implications on a fix and flip, because that's taxed at a total different rate. So what I normally do when I look at a fix and flip is not what my gross net will be, but rather what my net is going to be after my tax implications. And then I decide whether it's worth, taking on that job or not. Because sometimes a number may look really good, but then after I have to pay Uncle Sam his pound of flesh, it doesn't make sense, and I'll walk away. So
Yeah.
that's something I think that needs to be spoken about much more in our industry.
Yeah, exactly. I had this couple. He used to make, let's say, I think $700,000 or $800,000 from his practice, and his spouse had nothing to do. And everyone wants to flip, when the market is good, right? So the spouse got into flipping, and she was so excited. She was making 10 grand off of the flip after working for 5 months in this property. Literally 5 months, and they say, okay, this is 10 grand is better than nothing. In their tax bracket, if you live in California, we're talking about paying 50% and up in taxes. Income tax first, and then self-employment tax of another 15%, right? So we're talking about 65% in tax, almost to that amount.
It doesn't make sense. Why do
It
it?
doesn't make sense. You made $3,500 by working.
It actually costs you money.
Yeah, these are the opportunity cost and so many other things she could have done. So yes, taxes are so important. And she could literally, if she had planned it correctly, she could have kept that 10 grand, much better than 3 times the return that she got on $3,500, right? So to get started, I just want to say everyone, fix and flip. You just buy the property and flip it. You have no tax savings when you do that. The only tax savings when you have fix and flip is you actually lose money, which is a bad way to save taxes, right?
There is money to be made with fix and flips, but you have to account for the tax man. So let's say I look at a job and it says I'll be in it for, and I've done this, where I would only make $20,000. but I'm out within 45 to 60 days. If I could do that though, another 50 times over the year, then it makes sense, right? Because I'm out quick and I'm in, and it's not very labor intense, right? But if I'm going to be in, let's say, a luxury home, which I've done, where I've made, let's say, where I could make only $50,000, and I'm going to be into that, it's going to take me 2 months to get it done, and then another month and a half to get it on the contract, and then I got to wait for that person to get their mortgage in the Northeast. Typically, it could take anywhere between 45 days and 90 days. It doesn't make sense at that point to just work for 50,000 because I got my money stuck in there, that costing me money, right? I've got not only is it costing me money where I may be paying interest on it, but for the capital that I do have in there, I'm losing on what they call opportunity costs, right? Where I could have put that money somewhere else. And then I got to pay the tax man $25,000 of that 50. So to me, it doesn't make sense. I might as well just sit tight and wait for a better deal to come, right? Now, then there's at times where I could do, let's say, $300,000 on a fix and flip when the numbers are, let's say, between 600,000 to $1 million. I don't mind doing that because even if the tax man takes $140,000, I'm still good with 160 anywhere between 5 to 6 months. So, there's a lot of variables that have to go into it, but the variable that most people don't ever account for is paying Uncle Sam his pound of flesh when the deal is done.
Yeah, and that 50 grand, if you pay 25 grand, 50 grand, that's almost a full-time job for someone if you can put that in your pocket. And how can someone save taxes in fix and flip? It's very simple. And I think you're already doing this, but there are two ways. First of all, you need to have right kind of legal entity, right? If you have a right kind of legal entity, let's say in a C Corp and S Corp, depending on where you land from an income perspective, those corporations are needed for you to actually save taxes. Most of the time people will go for an S corporation now because you can make $1 million from a flip and use that money correctly in long-term rentals and offset the entire $1 million and save $500,000 on tax. Is that how it is? And that's why real estate investors love all this real estate tax loopholes and all these lawmakers so much, and they love it so much is because most of the real estate investors are wealthy, right? And mostly people only invest in real estate, and all the lawmakers also invest in real estate. So it's always favorable. Now, very simple. I just want everyone who's listening, who's doing this fix and flip, especially if the market is now changing, you're gonna have more of these. If you're fixing and flipping, and if let's say you're gonna make more than $50,000 and up, you really need to consider talking to your CPA regarding getting a right kind of legal entity first. And then now, once you have a right kind of legal entity, how can you have other investments in real estate to offset that $50,000, or if you make more completely, if possible, from real estate? It's doable. People do that day in and day out. That should be the goal. So for fix and flip, just to repeat, make good money, get right legal entity, and rightfully use that money you made and get a good class of asset so you can really wipe out your fix and flip income. That should be the goal for all the fix and flippers from tax perspective. Do you agree with that, Dan?
Yeah, what you just said, I actually practiced. So this happened about 4 years ago where I made a substantial amount of money on a fix and flip, actually 3 fix and flips that were higher end homes in New Jersey. And the way that I offset that was I did a cross segregation on 2 of my other properties that were under the same company name that I did those fix and flips with. So pretty much, literally the depreciation pretty much almost wiped out 2/3 of the profit money. And then the rest of it I just expensed out because there's tolls, there's car expenses, gas and repairs and office expense, things like that. So I barely paid any taxes on those large sums of money I made on those fix and flips. But again, there's different ways to do this. It's all about educating yourself.
100% correct. And since you brought up cost segregation, I can almost guarantee you, if you are a savvy real estate investor, if you have a good team, 95% of investors are doing cost segregation. Doesn't matter if it's 100% bonus depreciation or it was at 50% before the law changed. Either way, it still makes sense, right? This is the one way how real estate investors and real estate agents or whoever you're investing in real estate, you're paying virtually no taxes if you do it correctly, if you can understand cost segregation and how it affects you. Not everyone can benefit from cost segregation. I just want everyone to understand that, right? If you do fix and flip, and then you buy a long-term rental and do cost segregation, this doesn't mean that that's going to help you save taxes. It does not work that way. You do have to understand a lot of rules and regulations and meet a lot of requirements to do so. But you need to understand what it is, and this is available for you to learn, and so you can make it happen. I have clients who have changed their careers because the spouse was making 50 grand being a teacher. Once they understood these rules and implemented them, the family was saving $170,000 in taxes. So while quitting your job and then doing full-time real estate, building your long-term wealth, you're making 3 times of what you were making before. Everyone wins, right? That's how powerful the real estate can really change your career, your family, and you have now more time for family, your kids and stuff. It's just life-changing decisions. If tax can make that happen, if you have right resource. So all that being said, hey, if you do fix and flip, talk to your advisor about right kind of entity, cost segregation, your long-term building strategy, so you can pay zero taxes. I think that's a very good way to end fix and flip discussion here from what no one can tell you. We need to talk about is real estate and rental, because a lot of people do rental real estate, right? Fix and flip, you really need to like dealing with contractors and putting things on the market and those kind of things to do fix and flip. Those are different kind of breed. I get impressed with fix and flippers, but real estate investors, other rentals is another one. I had owned a lot of properties in the past, and man, it is stressful. But some people love it. They thrive on that one. They grow. They get 500 units in 5 years. Very possible if you like it. But we're talking about someone who just starts rental real estate. What's to be the expectation when you start from tax is what I'm going to talk about. If you have anything to add before I talk about that, Dan, I would love to hear about you.
You mentioned something about, 500 doors in 5 years. Look, when I get new real estate investors that come to me and ask me for my advice, and they tell me, well, I want to have 300 doors in 3 years. I'm like, what does it matter, the doors? What matters is the quality, right? And I'll give you an example. So I had somebody come up to me once and said they had this happened a couple of years ago at a conference, recognized me for social media, and I guess he wanted to impress me, and he was saying how he had 300 doors. And when I asked him, what is he making on what's his net on a monthly basis on those 300 doors? And I want to say, in comparison to somebody who works a normal 9 to 5 job, it was substantial. It was a lot of money, but comparison to real estate investors, congratulated him. But my partner, who's my brother, looked at me and goes, and you think that's great? And I says, no, but he's excited. I didn't want to burst his bubble. The reality is, what he was making with 300 doors, I make with 30 doors. Now I have more than 30 doors, but with just 30 of my doors, it literally nets me what he was netting with 300 doors. I want everyone here to understand that it's not the quantity that matters, it's the quality that matters. What matters, like, if you're making $100, $200 a door, I got to tell you, somebody comes to me with a deal like that, I'm not looking at it. I don't even want to pick up, if I had a property manager, I don't want to hear from that property manager for $200 a door. It's not worth my time, right? And I don't even want to spend the time to for a property manager for $200 a door. So, I just want to get across that it's not the quantity that matters, it's the quality of the doors that matter. All right. Because if you have 300 doors and you have 300 headaches versus 30 doors with 30 headaches, and you're making the same amount, which is better?
Isn't that happening more? I think where the market was last few years, people have been trying to buy these properties with a very slim margin. And this is where a lot of real estate investors are going to fail, because the economy has been doing great since long time. Now, as the economy comes down, which we have been trying to see a lot of tech layoffs, that's always is indication that something's happening. When things fall off, now we have a lot of investors where you say, we're making nothing from 300 doors. That's the time where Dan's going to go and get really sweet deals, because now he has a good investment, he has good cash flow, he has good credit, and bank loves him, versus someone who's just getting foreclosed. That's where money is to make. So a smart investor makes money when everyone fails, and that's exactly what Dan's going to do. And then to that point, so if you're new investors, your cash flow, don't I know there are different kind of plays in real estate, but mostly if you're getting started in real estate, always look for cash flow. And that's why I suggest people, because appreciation play can help you if you already have a very good paying job, so you can sustain if something happens. But if you're trying to sustain or passively supplement your income, don't count on appreciation. You always go for cash flow, right? Go for cash flow, make sure the property is a good property, cash flowing property, then you need to layer real taxes and how it can save you taxes. That's the secondary thing. But when you're analyzing cash flow, you also need to analyze, hey, if I'm saving 20 grand from this long-term rental in the first year, that might be like 5 years worth of cash flow from normal real estate long-term rental. So I'm already making 5 years worth of cash flow from just from tax savings. Do I care about the property as appreciation or cash? Those things do need to be considered, but if you can find a property that cash flows without even tax implications, tax savings, that's the best kind first. And then we're going to layer in tax, manage your tax correctly, so that you're a winner in every front. Nice cash flow, nice tax savings, it also, let's say, appreciates, and everyone wins. That's how new investors should look at the deals when you're analyzing the deals going forward. That's what my investors and I used to do, and it has paid, it has done well. And what Dan was saying earlier, you don't want to be those investors who just gets volume and have very little cash flow. If something goes bad, if the whole AC goes down, you have to change the roof.
I find that people who try to grow at that speed over leverage themselves. And that's the worst thing you could do in this business.
Absolutely.
In 2000, when 2008 hit, I was sitting on my hands, literally sitting on my hands for about a year and a half. My yard never looked so pretty because I had so much time to clean and plant and garden, because I was waiting to see where the dust settled a little. But since I wasn't over leveraged and my partner wasn't over leveraged, I actually went and took loans against properties that I had no mortgage on. And we just went out there and went butt crazy. We were buying brand new houses that were no more than 5 years old in a place called Point Siena, Florida, right outside Kissimmee, that were foreclosed on for 400,000 or 500,000. We were picking them up at 70,000.
That's where the money is made, right, man?
I mean, but again, we were able to do that because we weren't over leveraged. We kind of saw this coming. So, I try to tell people all the time, don't get anxious. Don't let your anxiety of missing out on something or thinking that you're missing out on something lead you down the road of making a bad decision. The one thing with real estate is, and I can tell you from firsthand experience, if you do make a bad decision and you have the wherewithal to ride it out, that bad decision, the real estate always rewards you in the long run. But you have to ride out the wave. It could be, 3 years, 5 years, 7 years. But again, that's if you have that wherewithal, that resistance, that resilience.
That's why I tell people real estate is very forgiving. If you can hold on. But if you're over leveraged and there's no cash flow, you're probably going to foreclose. You cannot hold out like normal investors. So 100% agreed with you. So for these new investors, though, the expectation is they look at the social media and they say, "Oh, I saved $100,000 on taxes. I bought real estate." That's happening a lot because the social media was not as prevalent a few years ago. Now I get prospects that would say, "Oh, I heard this in TikTok. True. Can you send me this much if I buy this $100,000 property?" And we have to educate them. And so I just want everyone to understand very quickly how this works. If you are a full-time employee, your household is a full-time employee, both of your spouse or you a single who works full-time employee, you go buy a rental property. Is it a tax savings? Yes, the tax savings is this. If your rental property makes, after all the expenses, makes $10,000, you might not pay any taxes on the $10,000. That's the tax savings, the extent of tax savings you're going to have. And that's a good tax savings, right? Let's say you make $300,000. You're in 30% tax bracket, let's say, as a single taxpayer, and you go buy a rental property and you make $10,000 extra cash flow. You're saving 30% marginal tax rate in the $10,000. It's a good tax savings. So you just save $3,000 in taxes. That's what it is. However, though, what is the goal and what everyone wants is, how can I buy this real estate and offset my $300,000 in W2 income, so I'm saving $100,000 in taxes? That's everyone wants, but you don't get that easily. Otherwise, everyone would do that, and that's what everyone used to do before 1986. People would, doctors would make $1 million, go buy, a lot of real estate and try to offset the income, and they used to pay zero taxes of the $1 million. And IRS came back and said, okay, you cannot do this anymore. That's where all this passive activity loss rules came into play. Meaning, if you're a full-time employee, you do not qualify as full-time real estate professional. Okay, there's an hour requirement. We're not going to go into that. But if your household do not qualify as something called rep status, real estate professional status, your real estate, your long-term rentals will never offset your W-2 income. If you make more than $150,000. If you make less than $150,000, then yes, it could offset up to $25,000. We're not going to go there right now. Okay, we're not going to talk about if your household do not qualify as real estate professional status, the long-term rentals, the extent of tax savings is only at that net income from the real estate. If you really want to switch over and really offset W-2 income, go talk to your tax advisor. Are there ways? Absolutely. Talk about buying a short-term rental versus long-term rental. Talk about you qualify as real estate professional by managing your hours or managing your career. It can happen. This was the example I gave earlier. If your spouse can manage a career where she's making nothing, but your tax savings can be $100,000, maybe you can switch up the career and start investing in real estate full time, or at least meet the rep status hours. That's what everyone newbie with investing in long-term rentals really need to understand. The tax savings, yes, to the extent of your net income from your property, it cannot offset W-2 income unless you do other consult and do invest in other complicated tax strategies, which you have to work with your CPA. And we get that. That's what I think everyone needs to understand that.
There's very few people that come into the business that understand that. And the other thing is, before I go into a specific area that I've never bought in, whether it be another state or county or city, the first thing I do is I call my accountant. I says, how is this going to affect me? Because every state, every city has different tax implications. So I always recommend two things, actually, that they sit with an attorney, a housing attorney, so they have a clear understanding of what the housing laws are and what they could ask in an interview, tenant applicant interview, and what they can't ask, and what should they expect as far as how long it's going to take to get rid of a bad tenant, as well as speak to your accountant, because even though the acquisition cost may look like it's extremely affordable, and let's say even if the labor and the materials are lower in that area for whatever that reason is, it still may not be a good opportunity for that individual based on their tax implications. So I can't stress enough how important accountant is part of the team. Like that is my right-hand person. I don't buy anything of any major amounts without speaking to my accountant first. Like, for instance, I just bought a new truck last year, and I wanted to know, okay, which one of my companies am I going to write it off from? And at what amount can I write off per year? And then I figure out, based on that, what my real net cost is of that truck. And then I decide, based on what that real net cost is, if it's worth purchasing for the business or not.
People pay us, let's say, $10,000 for a 1 year engagement. If they can save $100,000, that's a 10x return. No other investment does that kind of return within a year. And people need to understand that paying some professional is always worth it. And I agree with you. So we talk about fix and flips, very high level, what you should be thinking. We talk about if you buy rental property, hey, you need to understand how the tax savings works. I know we don't want to talk about a bunch of stuff, but I do want to talk about the two more topics, which is 1031st exchange and short-term rent, because those are the hot topic. Everyone wants to learn about them, but no one knows how to talk about them, and there's a lot of confusion. 1031st exchange, I want everyone just to understand this, right? If you have a property, if you're going to sell right away, right out, and you might have $300,000 in capital gain, you're going to pay, in your tax bracket, you might pay 60 grand in taxes. But if you do 1031st exchange and buy a similar value property, then there might not be any gain tax. You just use the money to buy another property. You might say that's 60 grand. If the goal was always to sell the property and move into bigger property, you should always do 1031st exchange. Right? Everyone needs to understand that, because there are a lot of people who will actually sell the property, and once they see the tax goal with Google saying, okay, I have this much tax, how to save tax when selling the property, and 1031st exchange comes into that, and Google tells you that, and they want to do 1031st exchange after you sell it. Doesn't work that way, obviously. Always make sure you talk before you make any decision, like Dan said, buying, selling, hiring people, always talk to your CPA. They will guide you, okay, hey, you're doing this, think about the interest exchanges or other avenues to save taxes. They will always say that. Only thing about the interest exchange is just make sure you understand, do it before you sell and talk to your advisor. That's the only thing you need to understand. There's something called 1030 exchange. If you're hearing this, when you're selling property, always Google this before you sell property. I guess that's the only thing I can tell right now without making it complicated.
Just to take that little step. So any real estate investor should be thinking long term, right? And I'm not talking about 3 to 5 years. I'm talking 20 years out, right? So we have utilized 1031 exchanges. Sometimes we haven't. I just sold the property slightly over 1.2 million in Brooklyn. I didn't do a 1031. I'm getting raped with taxes. But there's a reason why to do 1031, because there were partners involved. I would have to either buy their share out, keep that company name, but there's reasons why you want to do that. And not to say that I had a problem with the partners either, because I didn't. It was just time. When I have done 1031 exchanges, my plan is also to create a trust, which now that I'm getting older, I'm going to be doing irrevocable trust, so that when my kids get that money when I'm gone, they get what they call that step up value. Now they're not paying any taxes on any of that. So again, this is really higher end stuff, but I want everyone to think. I don't care if you have a 2-family building and it's your first one. You got to think long term and understand what at least the basics of these tax benefits to real estate, so that you have a plan and you can start generating a plan as you start to grow, and always, under the advisement of your accountant, who should be your number one team member.
Yeah, love it. That's what all the wealthy people do, right? They will pass everything to their kids at the end and pay 0 taxes and move on. Exactly what you're doing. I love that. A lot of people don't realize that you can do 1030 exchange and virtually pay no taxes once you pass away. Your kids pay nothing. So that's a very good thing everyone needs to understand. I'm glad you brought that up. And the goal is to talk to your advisor. Obviously, if everyone is different, talk to your advisor what you need, what you don't need, and they will guide you in the right direction. So that's the 1030 exchange. It can really just keep enrolling your money into bigger property, and when you die, your kid gets the money and those property for free without paying any taxes, no matter if you sold it for 1 million times, and then with $1 million gain, everyone wins if you do that. So perfect on that end. And the last thing I want to talk about is short-term rental. This is a hot topic. Everyone is doing this because of tax savings. This is what I want to talk about. Short-term rentals are basically, if you have a property that is rented less than 7 days on average, okay, that's like vacation rental, Airbnbs, Verbo, those are counted as short-term rental in IRS eyes. Why is that important? Why you talk about short-term rental is this. You know how before I told you, hey, if you have a full-time job and then you buy this property, it only saves you income at the property level, not at W2 level. Now, if you have a short-term rental, even though you have a full-time job, you don't have to qualify as a professional. You don't have to meet that 750 hours or 50% of what you do in real estate needs to be in real estate. None of those matters. There are some rules you can meet very easily, and then use short-term rental to completely wipe out your W2 income or business income and stuff, depending on threshold. That's why it's so popular right now. Everyone's doing it. I still don't even know how to handle this. We had a client who just got audited, and they don't know what's happening. And I'm trying to defend an audit for them. So and a lot of other clients, firms are doing the same thing because it's a new loophole. Everyone is doing it. They probably is going to close them in the next few years. So that's why everyone is scared. And we have clients saving $300,000 a year without even being a full-time real estate, which never happens. And that's what they're doing right now. And short-term rental in general makes you more cash flow than long-term rental anyway. So you're saving $300,000 from buying a property, $1 million property, let's say, maybe a little more. And then the property is still been making you $200,000 a year. People are really, really making a lot of cash inflow from short-term rental, especially with tax savings. And that's what the short-term rental is. So long-term rental and short-term rental are different. They work differently for tax reasons. And obviously, from cash flow perspective, they also work differently. Analyze your property on your own. But I want everyone to understand this. So do you be getting into short-term rental? Always talk to your advisor, because it's even easier for you to save taxes without even meeting the complicated rep status rule. talk to your advisor. I can't stress this enough. You might be losing out on a lot of stuff.
Yeah, I don't do short-term rentals because I don't want to be in the hospitality business, but I do know a lot of people that do and do extremely well, and they love the tax benefits from it.
Exactly. And I think it's gonna slow down. Obviously, the market is so saturated. But I just saw a report that this was growing at 10% rate, even though the market is bad. So people are investing in it. They're seeing something, but we'll see. We'll see how it's going to pan out for
I
everyone.
personally think that that side of the business is going to be really heavily regulated in the next few
Yeah,
years.
it will be. It already is, and a lot of people are so upset about it. But it's going to be even worse. So you have to be smart about it. That's why you diversify. You know, so some short-term rental, some long-term rental. Once you buy short-term rental, long-term rental also can save you a lot of taxes without even qualifying as you as a professional. I know it's. I don't want to get into too much complicated stuff right now, but all we need to care about right now is, hey, focus on, if you're fixing and flipping, make sure you know you have right entity. Make sure you are you have a goal in mind of investing in a long-term rental so you can offset your fixed and flip income. That's the first thing. Don't discount on. Don't just go into buying rental properties without understanding how it saves you taxes. Talk about 1031 exchanges with your advisor. Talk about short-term rental with your advisor. That's a very good start for someone who's just starting out in real estate. If you understand more than this, it gets complicated, you know, and you obviously have resources like Dan. You can always reach out to us if you have any questions, obviously. But that should give you a very high level starting conversation points with your partners, your investors, your lenders, so you can really be successful in real estate. And that's what I wanted to share today.
No, thank you. Thank you, thank you, and thank you. It's unfortunate, but I don't think this is something that's spoken about enough, especially within social media and within classes that people may be taking. It's not always how much you make it as much as it matters how much you end up taking home with you. I think I shared this with Julie where, I remember my first deal that I did over $1 million, with the guidance of my accountant. I had an offer for $200,000 more at 1.6 million. But I took the offer at 1.4 because they were willing to let me structure it on paper the way I needed it to structure for tax purposes. So although I sold it for $200,000 less, I still literally went home with about $175,000 to $200,000 more than I would have if I had taken the 1.6, because they were unwilling to let me structure the deal on paper the way I needed it to structure it so that I could save on taxes. So it's not always how much you make, rather, as opposed to how much you get to keep and go home with.
Exactly. I love that. Let's everyone think about that as biggest thing you can take away from this call. And hey, don't try to make more money, pay a lot of taxes, take less thing home, or just try to expand in a rate that you're over leveraged and taking nothing home and thinking you're doing the best. Don't do that. That's what Dan is saying. That's what I'm saying. Think about taxes, think about cash flow, merge them together, buy a good real estate, be successful. That's all we want, right? That's what we're talking about. So this is great, Dan. Thank you. Thank you so much for your time. Obviously, you have a wealth of knowledge. Again, thank you so much, guys. This is great. And hopefully we can do this again.
Thank you.